Morning. Welcome all to the Genghis Weekly Investor Briefing. And in this week, the past week that has passed, it has been very eventful, and we are glad to have our very own Churchill Ogutu, who will be joined by Mathew Kabeere later in the briefing to highlight what has happened in the past week and what we should expect in this week. So my name is Daniel Ogeto. I'm from the marketing department from Genghis Capital, and I'll be your host today. My colleague Damais Mukulu is not in for this week, and I think I'd like maybe to introduce other members present. That is Wesley Manambo and Melody Ndanu from the research department, and Dora Mbaye from our marketing department. So over to you, Churchill.
Thanks, Daniel. Good morning to our participants. Today, let me share my screen. Okay, I hope you can see my screen. So as usual, I'll walk you through the macro updates and fixed income before now we get into the equities, which also my team members will chime in the course of the presentation. So I'll start with this week's outlook. It's a bit light. We are waiting for some of the releases that were supposed to have been released at this point in time. So we have the quarterly economic and budgetary review as at the end of March 2021. So this is a quarterly publication from National Treasury that looks at the revenue, expenditure, and also the financing. But for this particular report, we're looking for the first 9 months of the current financial year. As I mentioned last webinar, for some of these statistics, you already have them. Things to do with, say, revenue. We know that it was 1.1 trillion ordinary revenue. So the only value add that we'll be getting from this report is perhaps what a miss or what a surplus it was. But all indicators are that ordinary revenue, there's a miss there. Getting on to expenditure, we also have some of the low absorption of the funds, but we'll be quite keen to see the nitty-gritties of the same. Financing, so far, domestic borrowing, total borrowing has gone up by 647 billion from July last year up until March this year. The target for the year is around 970 billion, but the specifics is what will be of concern to us from this report. Of course, there's the other report, 2021 Economic Survey, looking at the growth for 2020, employment, balance of payments, among other statistics from this seminal reports. But that said, I think the KNBS came out with a release, if not last week, the prior week, saying that there'll be a delay in the release of these pivotal reports. And of course, what we've been parroting all along, this fourth quarter 2020 unemployment rate, for some reason, it was supposed to be out by end of February. Now we are 3 months down the line, we haven't seen it. So we're just keeping an eye on the same. So let me move on to the fixed income asset class. Just a review of last week, it went up 5.1% to an aggregate 20.5 billion. And most of the trades were on the infrastructure bond segments. We've seen it playing out ever since the April infrastructure bond was issued. But nonetheless, in the last 2 weeks, we've seen most of the activity now getting onto the other infrastructure bond as opposed to the new 18-year paper. In terms of T-bills, we've seen that the overall performance as at last week's auction was north of 111%, which was 26.5 billion bids that was put by investors for the T-bills. All in all, we've seen that the yields on average across the board have edged up 0.62% on a year-to-date basis. And if you compare from the lows of July last year, we are seeing that they have increased on average by 1.57% from lows that were hit last year. Specifically for the last auction, we saw that at least, not even the last auction, the last 2 auctions on the 4-day tenor, we've seen that it is starting to come down gradually, nonetheless. Getting on to the liquidity trends, still we are seeing that in terms of the interbank, it's telegraphing that there is improved or high liquidity in the market. We saw that it declined. The average interbank rate declined by negative 0.34% last week across the board. In terms of the open market operations, that's where CBK assesses the liquidity in any given day, and if need be, it can be able to intervene. Last week, on 3 sessions, it stayed out of the OMO market, but it came in on Tuesday session, and it was basically to mop up the excess liquidity. It sought to mop up 15 billion. It received bids and accepted 21.4 billion at the weighted average rate of 4.164%. So all this somehow is telling us, if we look at these 2 indicators, it's giving us somewhat a mixed signal, but biased towards some improved liquidity. Let's see what this week has in store for us. Net domestic borrowing, from as per our calculation, what we look at from the T-bills and the T-bonds, we are at around 425 billion shillings that have been so far gathered or mopped or achieved from net domestic borrowing, of which that represents 78.7% of the quantum of the fiscal year, which is 540 billion. So moving on to last week, we saw the results of the tap sale came out faster than expected, because CBK was actually looking this tap sale to run all the way till Wednesday this week. And of course, there's usually a qualifier. If it has been able to meet the quantum, it's a fast come, fast serve basis at the tap sale, how we know it is. As it is. So it's announced this tap sale. I think it was on evening on Monday, but by Wednesday we had the results. So, and Mathew, this tap sale has a value date of next week on Monday. So here we are, I think a week plus prior to the value date, we already know the results. So nonetheless, I think, the bids that were accepted at face value was coming to 20.9 billion. At cost value, it was something north of 20.7 billion. So they were able to achieve what they were targeting to achieve, that's 20 billion. So, but what struck out in this particular tap sale, unlike the primary bond issue, we saw that investors pivoted towards the 13-year paper, that's FXD2 2019-15. Unlike the first one, which they were lackluster, there was a lackluster participation in the 13-year paper. This time around, I think it was because of my assessment of it, just looking at the yields that came out on the 25-year paper, and whereby 17 billion was rejected at the primary. So I think investors were just happy to get into the 13-year paper, and that's what played out at the tap sale results. So based on this tap sale results, we are a week's trade is now back on the FXD2 2019-15. Just looking at amount outstanding is 58 billion just before this tap sale. So if you include this 15 billion that is coming from the tap sale, I think it will be 73 to 74 billion amount outstanding in this particular paper. And as a weight of this paper to the overall fixed income or the overall fixed rate papers, I think it will be north of 4%. So it will be quite a liquid paper. So I think most of the activity right now that the tap sale is behind us, people will start seeking opportunities in this particular paper at levels of 12.6 to 12.8%. What we're seeing majorly is right before the auction, primary auction that was held 2 weeks ago, we saw that the yields on this particular paper was 12.6775%. This was right before the auction, and then the auction came at around 12.975%. So what usually happens is there's usually like a premium at the auction. So we expect that there will be a gradual bounce back to pre-auction levels. So investors or people who missed out on this paper at either the primary bond or at the tap sale, they may now be able to come in and seek opportunities between 12.6 to 12.8%. And I also think that from a seller's perspective, these levels is what will play out even during this week, now that the tap sale is behind us. So that's about it on the fixed income. So let me just move on to the equities. And I know that my colleagues will also chime in as we go by. So I don't know, Wesley, can you take us through this slide?
Thank you. On the equities, we saw on top gainers, we had Nairobi Business Venture, Everready, Crown Paints. On the top losers, we had Scan Group, Uchumi, and Express. What's important to note is the Nairobi Business Venture rallied from 4.37 at the beginning of the week and closed the week at 4.9, which realized a 12% gain in value. The rally is likely influenced by an impending deal on what the company called a prospective investment in a cautionary note that they issued at the end of last month. What we know about the deal is that its success will result in a change of the business structure and will dilute the percentage stake held by Delta, which is the majority shareholder at 84% of the company's shares. And for BOC and Olympia, they flopped from last week top gainers to this week losers, and HF Group and Everready flipped from last week top losers to this week top gainers. And as Mr. Churchill informed us last week, this is a trend that these companies have set in that today they are winners, the next they are losers. And the turnover of the market was up 14.2% to 3.05 billion Kenya shillings. From the week, what we noted is on Tuesday, we had I&M. Their share price declined against the backdrop of its book closure, reflecting the one-to-one bonus share that they issued. Also on Tuesday, we had the release of Sasini shares, this Sasini report. And towards the tail end of the week, we learned that the Ethiopian bid will allow, the Ethiopian bid that Safaricom is in will allow the winners to operate mobile services in a period of 1 to 3 years after Ethio Telecom launches its Kabeere, which is its mobile money platform. So that closed as a good news to Safaricom after it's reported a decline in their earnings. That's all from my side, Mr. Churchill. Back to you.
Thanks, Wesley, for those high-level analysis of last week's activity. So just to get into the foreign activity side, in terms of participation, we have foreigners. I think this is the first time in as many moons that you're seeing foreign activities declining below the 50% mark in terms of their participation at 44.4%. And in terms of the activity, they flip-flopped from net inflows that we've seen salient in the last couple of weeks to net outflows to the tune of 580 billion. Well, foreigners were accumulating on Safaricom, albeit at lower turnovers at around 9 million that we saw in terms of foreign activity, but they were exiting or profit-taking on Equity Group, EBL, KCB, and Stanbic Holdings. I'm not too sure whether Melody can comment on the bank's activity last week, or you can just move on. Melody?
Please unmute.
Sorry for that. Can you hear me now?
Yes.
Yes. Good morning. For the banking sector, I think you've covered it well. It's just mostly people taking the profit taking after the dividends book closure. Mainly, that's it from my end.
Okay, thanks. Short and precise. That's what has been playing out in the banking sector, as per Melody, as what has she said. And you think we see, I think, KCB at around 41 levels, equity at 40 levels. I was seeing that at these levels, their profit-taking activities will continue playing out. Still, they are far below the 2020 highs of 55 shillings per share. I think they'll keep on, we expect to see some range-bound trading even as we forge ahead, and as investors start to see even the 1Q numbers, which should be out sometime later this month. So technically, sometime this week or even next week. We still don't have the dates from the banks. So that's something that investors should be keeping an eye on. So moving on to, and where the NSE sits vis-a-vis its African peers, in terms of the market price to earnings ratio, it's slightly overvalued against the markets that you are keeping an eye on. At where NSE is at 12.7 multiple against 11.1 multiple, the peers that we are tracking it against. And then dividend yield is slightly below at 2.2% vis-a-vis 5%. No brainer here. What you've seen even playing out in the last couple of over the latest round of earnings results, you've seen that more and more companies, the ones that are releasing, they're releasing below than historic trends, dividends, DPS, dividend per share, or most of the companies have stayed out issuing dividends just to buffer their companies in light of the COVID-19 pandemic that we are in at the moment. So moving on to the corporate calendar, this week we expect the book closure date on the Stanbic's Holdings final dividend, that's 3 shillings and 80 cents. That will be on this Friday's trading session. That's the book date. So, and then the rest of the corporate calendar will take out or will take place from next week and spill over into June and finally July. So in terms of the trading ideas for the week, we are still bullish on those strong stocks that can be able to weather the COVID-19 storm. I think we are in the third wave of COVID-19 pandemic. There's also the threats of new strains coming in. So it's still a layer of uncertainty how COVID-19 will progress. So investors are pivoting towards those names that can be able to weather this storm. Specifically for this week's trade, we're looking at Cooperative Bank, where it's now come full cycle back to where it started the year at. As we've seen that it's been down negative 0.4% on year-to-date basis. Its price to book is slightly attractive vis-a-vis the peers at 0.86 multiple against the sector of 0.92 multiple, and its return on equity is better than the sector at 13.7% vis-a-vis 10.4%. So that by the virtue that it's roughly 7.1% from the target price. We had a target price of 13.34. I closed last week at 12.45%. So there's a price upswing of 7.1%. So that justifies our whole recommendation on the counter. So that's pretty much it in terms of equities trading ideas for the week. So I'm not too sure whether Mathew is on the call, so you can walk us through the. Mathew is in. Mathew, happy to see you.
Thanks, Churchill. I'm here. I was a few minutes late, but yeah, be sure to check into the markets. Let me share my screen. I don't know what you can see.
Yes, you can see. You can proceed.
All right. Just a second, please. Just want to make sure I'm sharing the right screen. Okay, yeah, ladies and gentlemen, let's look at the markets, the global markets. So last week, let's do a recap of last week. US stocks slipped while the dollar rose as inflation numbers reached levels that have never been seen for quite some time, and that one reignited concerns of higher interest rates. And just to speak a little bit about this one, we had inflation numbers coming up last week, US inflation numbers, and they came up sparring out a flip of the stock. So oil prices have been trading in a range, but buyers seem to be in control, as International Energy Agency stated that the demand for crude oil is outpacing the supply. Of course, you all know that economies are literally rebounding from the COVID as there is gradual reopening. So it's like demand is a little bit getting up, outpacing the supply, and still oil, especially the US oil, suffering a hitch because of the attack on their pipeline. But it's already been worked on. But those are the aspects around the oil as at last week. So for the ECB minutes, retail sales data showed that the sector stopped growing, but the Euro USD still remains stable. If I check on the chart, the Euro USD remains stable around 1.2. So moving on to what we are looking forward this week. Main events, we have PMIs, or Purchasing Managers Index. Those surveys are coming up for the survey results are coming up for EU, UK, and US. Those are going to give an idea of where the economic activity is, or the level of economic outlook for those countries. And when it comes up, if it's positive, then of course it's going to indicate the continuous or the continued trend of recovery from those economies. Or else, if it shows worse than expected events or results, then it's going to mean that still the economies are in a longer haul. Europe, rapid vaccinations was allowing several countries to reopen, and there's gradual reopening across Europe. The economy is failing and starting to show signs of recovery. So the PMI is what they're going to confirm, whether it's actually a recovery that can give traders an optimism even to go to riskier assets, or they still have to remain a little bit careful. So for UK, it's going to be a super busy week with the jobs numbers for March. There's quite a lot coming up for the UK. That's going to affect the pound. So jobs numbers for March come up on Tuesday, as we will see on the calendar. Inflation statistics still for April coming up on Wednesday for the pound still. Retail sales and the flash PMIs coming up on Friday. So quite a lot for the pound. And this one means that we are likely to have some opportunities and some volatility on the pound. Whenever these news come up, either positive or negative, if it's as much surprising, then it means that is likely to be high volatility affecting the currency pair of that specific country where we have events happening. And then that's why the opportunity comes in. Or if you've been having positions and those events come up, cause volatility, then it's time to tighten up the risk management to avoid big losses. That's what the events mean for us. That's why the economic calendar is quite important. So PMI reports for the UK, they'll give confirmation whether the British economy is it's actually sustaining its growth. And last week we spoke about the S&P. So S&P, the party, the elections on the Scottish side of the UK. Right? So Bank of England have taken the first step towards ending its quantitative easing program. And traders seem to have concluded that the risk of a second Scottish referendum isn't very high after the Scottish National Party failed to secure an outright majority in the local elections. So that conversation might not be quite far from happening, because they just fell short of just a single seat. We don't know what might happen, but there are quite a lot of opportunities that are likely to show up on the side of pound. US latest Federal Open Market Committee meeting on Wednesday, but data which has been coming up, of course, for the US has been a little bit surprising. So we pay attention on how the Fed's take a stance, or the stance they take on handling the inflation. That's where the markets are stuck on, because currently it's just heating up in the US side. They are allowing inflation to go up, and when data comes up and it's like it's now supporting whatever the Feds are believing, then it just holds the investors in at some form of there's no clarity, if I have to select the ones, no clarity. So still waiting to see how the Feds are going to deal with the inflation. But currently it's just giving US dollar some strength because of the recovery, of course, but inflation is still a worry. So it's just a balance between strength of the dollar with the strong data coming up, and of course the outlook on recovery. And then that's when again is being negated by the fact that inflation is coming up, and that's what is actually spurring the profit, the take of the profits, or profit booking on the side of the stocks. Because of course, when inflation comes up, sometimes it supports, it means growth. Whenever the data supports growth, then it's good for the stocks. But then when the inflation starts rising so high, then it means that it's going to affect the earnings, because of course inflation negates it lowers the value of whatever you're earning from the markets. So those are the things that the traders are struggling with all along. So in the economic calendar, this is what is lined up. You can check out on your favorite economic calendar that you use, but these are the key events. Japan preliminary GDP, right? Today, tomorrow, we have this event, S&P, to the Swiss National Bank for the CHF, the ones who trade on that one, and a little bit of Australian monetary policy. Wednesday, that's why we have the UK CPIs. That one is going to give information about their inflation numbers. You have the US crude oil inventories, FOMC meetings. And on Friday, well, Thursday, you see unemployment claims for the US, of course, Philly Fed Manufacturing Index. All this showing the level of whether the economy is actually recovering and supporting the recovery. So Friday is quite a day to watch, because you can see we have flash PMIs for EU, for UK, and US. It's really going to move the market. So whenever you see this news for the specific currencies that are going to affect, there's going to be volatility. Yeah, if there's volatility, then it means that you have an opportunity. And for that reason, just make sure you get it at the best time to take opportunity of it. But if you're not quite sure how you're going to trade it, then better wait for between the time when that event is being released, maybe for some 30 minutes before and maybe 30 minutes after, to see how it pans out or how it shows up. And then you can check out for your most favorite trading signal or setup in the market for you to find an opportunity. So that's what we have lined up for the calendar this week. Products of choice to watch this week, of course, based on what looks out there, is the Euro USD. Oh, Euro USD. It has been stable, and it has extended a rebound from the weekly lows after the release of upbeat US inflation data on Friday. You can see it's trading above the moving averages, above the 200, above the 50, above the 20. Yeah. So as at the time I was capturing this chart, it was at 2145, but currently it has just taken a small pullback, still holding around that 214 and 213 levels. So you can see the oscillators, the momentum above 100, RSI above 50. That's supporting the uptrend and still trading above the moving averages. So for the upside, the traders looking for one to hold positions, long positions for the upside, we need to see the price maintain a strong, maintain strongly above 1.218. Yeah, maybe above 1.217, 218, and we might maybe want to see above that position. We might want to take long positions all the way to 224, the February highs. And the support level still remains at 1.2, although we have 1.20. That's what has been holding on for quite some time now, but still 1.205 is another support level. So long as the price is above the moving averages, and that's support to look for long positions. But for good positions to the upside with above 1.2185, in my opinion, according to technicals on the chart. So gold is another instrument we're looking at forward. There's been recent strong earnings reports from no, that's not for this one. Right, but let's check out on the charts. The technicals, looking at the oscillators, momentum above 100, RSI above 50, still supporting a strong uptrend, and price above the moving averages, that still supports the uptrend, right? So still we have the price, the key support level we're looking at is 1800s, but currently in the short term it's 1815. So the price is just above the moving averages, and so long as it maintains above the 1855, which currently is at 1855, at the time as I was capturing this chart, it was at 1843. So you can see that at the beginning of or during the Asian session, when it opened up, still the prices for gold were able to pick up. So currently around 1855, if it maintains about that around that level, then you're likely to see it going even higher, because the above 1850, maybe to the 1870s, all right, maybe to 1890. So that's what we're looking up for on the gold. For that small part there, it's not part of this one, right? So no, it on the earnings report for the stocks. Last week I had a webinar on how you can trade the stocks, and earnings was part of the things that traders are supposed to look out for. Check out on the earnings report, check out on the dividends, and this is what we're giving you. So for this week, we have the earnings reports for Ren Air, Tuesday, Tata Motors, and all those lines up there. I can't read all of them. Thursday, EasyJet, and then we have Friday, all this. So make sure you check out when those reports are coming up, and if it's affecting, it's something you might want to use to direct you towards the stocks that you can speculate and take an advantage of. All right, so those are the earnings we have lined up, right? If it comes up better than expected, then of course, you know, it's just positive sentiment for that stock, and you might want to check out for a position. For the dividends, it's quite a lot lined up there. Remember, when dividends come up, when the dividends are announced, it just makes the stock tick up by that amount. But when it's paid up, then of course, there's a pullback of the same amount. Also, after the dividends is announced, if you have not taken a position on that, of course, depending on your analysis, you might want to get a position, of course, on a pullback. That's what we have lined up for the dividends. So make sure you check out and take advantage of the markets as well. All right, and that's what I had for you this week. Over to you, Churchill.
Thank you very much, Mathew, for your presentation. There's one question here for you. I think for the rest of the participants, should you have any questions, you can direct them to the Q&A section or the chat section. So they'll be answered by our panelists. So Mathew, please confirm if through FX Pesa investors, if through FX Pesa, like investors can access the S&P 500 stocks directly. Can they?
Yes, of course you can confirm, and yeah, you can confirm. We have got quite a number of indices there. You can get the US indices, UK indices, Asian indices, and even European indices. So you can get the S&P 500. It's trading as US 500 roll. We can get the Dow Jones trading as US 30 roll, and even the Nasdaq trading as UT 100. So we have all those. For the UK side, we have the UK 100 roll for the FTSE. Okay, so yes, you can find all of them. Yeah, we have those indices there. Maybe if you can allow me to share the screen and show you.
Yeah, sure.
All right, so just a second. Let me just share my charts with you and check out of the indices that we have. Yeah, you can see here we have the US 500 roll, right? There we have US 500 roll, and UK 100, that's the FTSE, right? US 500, yeah, that's the Dow Jones. U200 Nasdaq there. Australian, it's here as well. So there's quite a lot. China, the Chinese index, it's here as well, trading above the moving averages, above the momentum. For the Euro 50, you're trading above the moving averages. France, CAC, it's here as well, trading above the moving averages. So if you wanted to have an outlook, of course, you can see that the Dow Jones trading above the moving averages. That's daily on the 4 hours, but we had quite a pullback here with the profit taking, of course, but it has buoyed again back above the moving averages, and the oscillators are showing an upward move. So still opportunities for traders to take outside there. You can see whenever these indices just spring in, trying to break the moving averages, then buoy up again. This is an opportunity for traders to get in for maybe long positions, right? US 500 there, still above the moving averages, but have to wait for it to get into that channel again for an upward move. So yes, we have all those indices. You can check out for them, and of course trade out.
Thank you, Mathew. Lawrence Njihia is asking, can I buy foreign stocks through FX Pesa?
Yeah, you can trade on the foreign stocks. Still, I will still share my screen to show you that. And we have quite a lot of stocks. So when you go to the charts where you can add all those stocks, just a second. Yeah, you can see all these that we have. So yeah, there's quite a lot that you can add to the charts here, and you can just, for example, if it's the Disney and you wanted to have a look at it, you can always add them to the charts and check out on how you can, the opportunity you can catch out there. All right, we have all of them here. Aviva, I see Rakitenberg. There's quite a lot of them here. All right, so most of the time when they're grayed out, then it's not yet open. Their markets are not yet open, so you have to wait. But yes, you can trade on so many of these. You can see Chewy, Tesla. Maybe you can make the screen bigger for you to see. Quite a lot of them here. Okay, Chewy, Tesla, Facebook, Baidu, PayPal, and Nvidia. But when they are grayed out, it's not yet open, so you have to wait up until it's open for you to trade. Remember, these ones are traded when their sessions are open, and right now, the session which is open, I think it's for the Asian side. So we're waiting for 10, around 10, that's when the UK session will open. Around 3, that's when the US session will open. But yes, you can take advantage of those stocks. They are here as well, and you can analyze them the same way you want to analyze any other financial instrument. We even have our local stocks. So you can Safaricom, KCB, EABL, can as well take advantage of them. We even have NSE 25. We have all of them here.
Okay, thank you very much, Mathew. Anthony Sure is asking, as inflation starts picking up, which NSE counters stand to benefit in an inflationary environment? Yes, over to you, Churchill.
Oh, that's a great question. And somehow I was just putting my thoughts in order so that I can build a conversation with Mathew. You know that me and Mathew at times we just like to exchange ideas over here. So, and it's something that you had mentioned earlier on in terms of inflation. So I don't know whether I can bring it at this point or we can just get into the question posed by Anthony Sure. Sure. I hope I've got the name correct. So, wow, it's really quite interesting. But ideally, you look at the companies that can be able to pass the cost to consumers in a more meaningful way. Because right now, what I can say for the Kenyan context, because now I'm just trying to bring it back at home, we've seen that over September up until March this year, the inflation numbers, you've seen that it's been on an uptick. And that is not even a surprise. Looking at the trajectory of the environment, macroeconomic environment, coming from a place whereby there was that severe lockdown, okay, not lockdown in the sense that we are not totally getting out of our houses, but we had the sense of when I talk about lockdown in the Kenyan context, whereby from April until June, the curfew hours was starting from, I think, 7 p.m. up until 4, 5 a.m. And there was minimal movements, even in some from Nairobi to other areas. So within that context, those measures were lifted up by the time we were getting into third quarter. And now, as demand started picking up, you saw that it started being reflected in the inflation print, in the Kenyan inflation print from September up until March. But now for the figures for April, I was actually looking at them. It was 5.8%, which was a marginal drop from 5.9% that was then in March. So looking at the counters that are able to pass the costs to consumers, I think which industries are those, like say agricultural stocks. But most of the agricultural stocks right here, they are mainly for export. So that's another factor comes in, the currency exchange. Manufacturing, not that much, because you find that there are some contracts that they have. So they have, in a way, the prices do not adjust as significantly as you'd expect. So at the moment, I'd say that we've seen it's basically a neutral effect impact or what's happening in the inflation from an inflationary perspective. And to be exact, we're not seeing that inflationary print or inflationary situation as meaningful as that will warrant a significant price uptick. I think by and large, if I could just put a name to the inflation print, I could now pick full inflation, which as at the end of April was at around 14.8%. Looking at the April numbers that came out over the weekend, or it was on Friday, it adjusted the prices for super but retained the other prices. So the main beneficiary, if you ask me, is just Total. Total is the one, OMC, oil market company, that is listed in the NSE, which will now be direct beneficiary of what's happening from the April review. But of course, it tends to have some second round impact in other counters, but it's not as meaningful that could, unlike other counters or other economies such as the US, whereby an inflation print comes out, like that was the case last week on Tuesday, which was a surprise to the market, because the market were expecting something like 0.3% month-on-month increase in inflation. It surpassed, it was 0.8% month-on-month. Year-on-year, it was 4.2%, way higher than even what the market was expecting. So you find that some of the stocks that investors had positioned themselves to a low inflationary environment stamped. Stocks such as technological stocks. So at least there's more information, there's an informationary symmetry in some global economies, which is not outright visible in the Kenyan market, if I may just put it that way. I hope I have answered it.
Yeah, I think you have answered it quite well. Mary Njogu is asking, can I invest in Fidelity Zero Market Index via FX Pesa?
Sorry, please, you're talking about Fidelity Zero?
Yes, can I invest in the total market index via FX Pesa? And then maybe you can couple that with the buying and selling of US physical shares. That is by Peter Waititu.
Fidelity Zero total market, I have not heard of that, but all the global financial instruments that we have, we find them on the market watch that the traders can take advantage of. If you can't find that, . Yeah, all the financial instruments that you can trade, you find them on our charts, right? If they're not added there, then you're not able to trade on them. And they are added on need basis, all right? So I don't think whether we have that fidelity stock on our charts currently, right? So the other one was about
are US physical shares available on FX Pesa?
Yes, of course. Okay. Physical shares, let me maybe try to separate them here. You see, when you're trading the stocks on these markets, you're trading them as derivatives, or most of the times as synthetics. So what's happening is that whenever you're trading on these stocks on through a broker online, is a derivative. It's not like you'll have a physical share so that you can get dividends and get maybe earnings. What happens is that you're trading on you're actually trading on an underlying asset, on the value of underlying asset. So if it's, for example, let's say the Apple stocks, when you buy the Apple stocks through FX Pesa, then you're trading on a derivative. You're trading on the movements of the actual value of the actual asset, but it's derived. You won't be getting any dividends if you're trading on a derivative. So you can't trade on the physical asset here. It's just a derivative of an asset at all.
So one is not able to get dividends.
Yeah, you can't get dividends. You just benefit from the movements of the prices.
Okay.
You see, maybe, sorry for cutting you short, but one thing is when you're trading on those assets as derivatives, actually it provides you with an advantage that you don't have to spend quite a lot, because you realized on the derivatives you have here, they are leveraged. So you're able to trade with a very small capital, right? Which you could not be able to do if you're trading if you're actually buying or exactly the same amount of volume on the stock exchange. So it's an advantage. You can you can buy or sell, you can trade on those assets even with a small capital because of the leverage. But when you go to trade on this on the physical assets, it might be a little bit expensive, having in mind that the leverage or the margin is the leverage is quite little when you're trading on the physical stocks themselves. So actually it's an advantage.
Okay, thank you very much for that explanation, Mathew. Kamau is asking, besides Centum, which other 3 undervalued growth stock are there at the moment? Churchill?
Well, in terms of the undervalued stocks from the prism of Genghis playbook, we had Kabeere, which at the beginning of the year was undervalued from the position that it had some substantial upside against our target price. And that is still playing out. Looking at Kabeere in terms of price to book metric is still below 0.2 multiple against sector. This is the insurance sector, which is north of 1%, one multiple. By price to book, I mean that percentage of the price per share, and then you compare with the book value of Kabeere per share, and then you just work up the metric. So it's below against the insurance sector. But of course, I think the market by and large are discounting the fact of perhaps the government shareholding on this counter. And also, I think 2 weeks ago, Kabeere came out and said that there'll be a delay in publishing of its results. I think there was something in something to do with the change in actual valuation or methodology. So by and large, that is the one stock that screams in our radar in terms of the undervalued stocks. Basically, for the growth stocks, I think we can be able to comprehensively cover it, and then we can be able to give a more elaborate picks even in the subsequent webinars.
Okay, thank you very much, Churchill. There being no question, I'd like to thank all of you for attending.
Can I just have a conversation with Mathew?
Yeah, sure.
Something to do with inflation, because and actually Anthony had brought it up in terms of the NSC. And looking at the inflation and this inflation jitters across the global markets. And by and large, even looking at the data that came out last week, it was way better than expected. Even leaving aside this noise that you've been seeing a bit in non-farm payrolls for April, disappointing, a huge disappointment, retail sales, another disappointment later on last week. So that tends to solidify that there's a bit of some noise before we get into some proper signaling, even what you're talking about inflation. But having said that, just to focus on inflation, because what we've seen gradually is that perhaps it's something that might even fade off, even what the Fed has been alluding to, that it's transitory. And to be sure, you're looking at some of the pent-up demand. For instance, if I may take Damaris as a boogeyman, in this conversation, she went to Maldives over the weekend to take a holiday. This is just a makeup of the holiday that she missed out last week. And we've seen that by and large, this pent-up demand or consumption that are starting to come in, and are seeing some of the commodities prices such as, is it lumber or timber? Timber in Kenya, lumber in the global markets, skyrocketing. Oil is up 30% year-to-date basis. So all these indicators are obviously pointing towards inflation. And I like something that you said, and I think what dovetailed with Anthony's question, because of inflation coming up, and it will have an impact even in the earnings or that pass through to consumers. So basically, now getting into this whole conversation about inflation in the Kenyan context, because I have conversation with the fund managers or the institutional clients, and one thing that they keep asking us, not only me but even peers in the industry on the sell side, is what's your inflation projections? Because they know that instantly, if inflation is higher, and most of some of the institutional clients have higher mandates in the fixed income category, it will mean that even the yields will go up. And the intent for that will be knock-on impact of yields going up will be, they will have to revise downwards their bond valuations in commensurate. And that's something that it's really, it's a headache if we are looking at it from the perspective of inflation in Kenya. So by and large, I think that in my view, in my assessment, inflation, even if it was at 5.8% in April, it will still be within the target that CBK is looking at. That's between 2.5% to 7.5%. In as much as fuel inflation is threatening, last print was at 14.8%. Even if super petrol went up, the other fuel commodities somehow remain stable. So even from a perspective of from a Kenyan perspective, I think that inflationary pressures will perhaps be neutral. It won't be as a runaway inflation that's what is expected in other global markets. Core inflation is quite below, it's below 3% level. So by and large, we're seeing that the economy, Kenyan economy, is not as, the demand pressures is not as outsized as what's there in the global economy. So,
Churchill, just to maybe to add it, I will not cut you short, but maybe to add into your conversation. Well, when we're talking about inflation, there are two sides of inflation, and that's maybe what we have to understand. But that when the economies have been quite beaten up during the COVID times, you see people there's been little credit, people have had little amount of money to spend, right? Even manufacturing has been down. And, you know, this is a cycle where whenever the consumers don't have money to spend, then it means even the manufacturers are going to spend down, are going to bring down their prices, and still that's when it just trickles down to is it shrinking of the economy. So the situation that we are in, and we have been in and we are recovering right now, is that there has been little amount of money in the hands of people and low purchasing power. So over time, let's check out on inflation. When inflation starts setting in, when people do not have a lot of money, then it's coming up as something positive, because it means that now guys are getting some money to spend. So that's positive. It's indicating growth in the economy. So it has to go, it has to surpass a certain level for it to be considered now having an erosion effect on the investments or on the earnings that are coming up. So I think in the short term, of course, the outlook of the central banks in the short term, it has to be allowed to a little bit rise, to at least give strength to sectors to rise up, people to have some money to spend. In that event, start creating some jobs. In the same way, we have manufacturing trying to rise up and raising their prices. But in the long run, that's when that's where we have to see maybe government coming up with measures to try and cap that rising, because when inflation is coming up still, interest rates try to catch up with it, though in an organic manner. But in the end of it all, inflation, of course, surpasses the interest rates, maybe for lack of better way of expressing it. When we have inflation rising up so much, then of course, even if you raise interest, it's just all of it just tries to decrease the value of the earnings that you've got. So at the end of it, or in the long run, that's where we have to see the curbing of the interest. But currently, I think, yes, it has to be considered transitory, right? Because of course, I've read out widely that it's being said it's transitory because of the basal effect. We're coming from a time when the inflation had gone so low. So when you compare the current levels of inflation, how they are rising with where it was previously, of course, you're going to see quite a very big change. So in my opinion as well, and in agreement with what Churchill is saying, of course, we can't avoid the current rising inflation over the short term, but in the long run, because in the short term, it's indicating that we are recovering, but in the long run, that's when it's going to keep on eroding the returns and whatever people are earning. And that's going to, of course, invite some form of intervention from the government. And I think on the side of the bonds, so you're talking about the bonds and the stocks, remember, it's the investors always want to see what's giving them better returns. So if the bonds are giving you better returns currently, then you have to go to them, right? But if the stocks are giving you better returns, then of course you have to stay with them. So when there are shocks in the economy, and I think last week a question arose on whether we are risk on or risk off, because currently it's just in between. We're coming from a risk off a situation, getting onto a little bit to risk on, right? But still not quite stable because we've not yet recovered. So when it comes to the shift between bonds and the stocks, it's all about what can give you better returns. If there are still risk, there's still risk in the market, people will consider going to the bonds, right? But if as the risk waits off, and as of course economy gets stronger, all those risks going lower, then of course you have people getting back to stocks, because stock in the long term they give higher returns. And maybe still to add on to that, at the moment, it's about going to the cyclicals, because cyclicals tend to perform better. Currently, you can see that as the world is getting to start traveling a little bit, getting to at least restaurants getting open. So we have the restaurants stocks getting better, the airlines getting better. So a little bit going to the cyclicals a little bit. That's what I have to say in this conversation about inflation and upbeat data coming up, supporting the growth and rising up of the economies back again. Churchill?
Yeah, you've at least elaborated more. We're on the same page, absolutely. So we are just comparing notes. Let me just
yeah, sure.
Notes here. Yep. Done?
Yeah, I think to add on to that, Ian Wangai is asking, with the $2 trillion infrastructure deal, is this one of the reasons for the rise of inflation in the US?
Well, it has been considered to be one, and of course, yes, because one of the things, one of the reasons why the inflation is being considered transitory is because people are offered those checks, right? And it's like they were like binge spending. I don't know the right one to use, binge spending. So it's being considered transitory because over time, as they spend, they're going to maybe stimulate the economy to rise up a little bit. But then over time, people are going to get back to the normal, maybe to real. I don't know the right one to use, but maybe to real inflation levels, where now it can be used as a basis of maybe readjusting the inflation. But yes, of course, it's one of the things that has been, it's one of the ways that the government has stimulated spending. It must have contributed to the inflation. And so over time, I think it might be transitory, and then getting back to the inflation that is generated by the actual economic activity based on employment, based on the manufacturing, based on spending from after actually people's work or employment. That's what I can say from that. Yes, it has contributed.
Yeah, if I can chime in, specifically for the infrastructure bill, which is different from the stimulus bill, which is so people getting paychecks to their on their, what is it called, the postal address system. For infrastructure bill, so specifically there's some netting of how do you fund, because infrastructure bill is things to do with building roads, bridges, and whatnot in between that could be pigeonholed as infrastructure. But on the other flip side of that, there's the how do you fund this grandiose 2 trillion infrastructure. So on the other side, we've been hearing talks about increasing taxes, talks about, I don't know, increasing corporate taxes on one hand, increasing taxes for the wealthy people in the US. So far, I think they haven't been firmed up, but that's one of the things that is supposed to net off or ways of funding this infrastructure bill. So in a way, and this infrastructure bill is spanning not just one fiscal year, but multiple fiscal year, I think 10 years. So in the long run, you see that on one hand, you are trying to spend money, but on the other hand, this money that you're spending is coming from some increase in taxes one way or another. So that tends to have, to an extent, some of offsetting effect on inflation. So it balances off, if I may put it that way.
Exactly.
Yeah. Thank you, Mathew and Churchill. Casper Lidiema is asking, any effect on the Fusion Group investment in Meru on the markets in general and specifically the real estate? I don't know whether Churchill, you may have Mathew.
We don't have visibility on the real estate investment, just from a point that we focus on the listed counters. By something we can take it up and build it up, but at the moment we don't have a concrete answer in regards to a specific real estate investment.
Okay, so there being no more question, we'd like maybe to thank the participants for attending this webinar, and we hope to see you in the next week. Thank you, the panelists, that is Churchill, Wesley, and our guest, Mathew Kabeere, and also Melody and Dora for the support. And we'd like also to wish you a happy investing week and see you once again in a week's time. Thank you very much.